Just when we thought it couldn't get worse, it continues to get worse. It is Tuesday, April the 29th, and this is Markets with Megan. If you like this podcast, please subscribe, hit that alarm bell, and you can share it with friends, family, or colleagues. But we're here today to dig into some of the economic data we got this morning, and it's on consumer confidence. I feel like a broken record, but every month we come out with different consumer confidence readings that just get worse and worse and worse. The Conference Board this morning released the consumer confidence for the month of April, and it was actually came in below expectations, and it's the lowest level since May of 2020. And that's really the depths of the pandemic. The expectations component, which is confidence on the future expectations of the economy, that fell to the lowest level since October of 2011. To put that in perspective, we were in the depths of the European peripheral debt crisis. We were coming out of the worst recession since the Great Depression. It's never been this low, that expectations component, aside from that European peripheral debt crisis. It's never been this low, and we have not been already in a recession. When we break down some of the details, it was really led by the concerns about the employment outlook and also outlook on income levels. But when you look at age levels, the biggest drop we saw was in the age group of 35 to 54. And what's surprising is that some of the upper income has held okay in a lot of this turmoil we've seen in the markets, as well as the slowdown in the economy. But we saw the biggest drop in the month of April in those income levels above 125,000. So it's starting to spread across not only age demographics, but also those income demographics. We saw the jobs hard to get component that rose for the third consecutive month, and that can sometimes be a leading indicator for what to expect on the labor market report. The other indicator that's kind of troublesome for the market is that the inflation expectations for the next 12 months, that rose to 7%. That was the highest level we've seen since November of 2022, when we were dealing with the post-COVID related inflation that we saw after COVID. Now, then what is the market doing on this? The market's actually up today, and that may be surprising, but when you see really, really disappointing economic data like this, you tend to see investors and market expectations increase the estimates for what the Fed can do, and expecting that the Fed will come in and cut rates sooner than later, and that can be positive for the equity markets. We also had some decent news on the tariff-related front when it comes to autos, so that's helped with the market today. It's a data-packed week this week. It's only Tuesday. We'll be back tomorrow. We'll get the first reading on GDP. We'll also get the Fed's preferred inflation indicator, and then we'll get ISM manufacturing, ISM services, as well as the labor report will end out the week for the month of March. That's all we have today. If you would like to see a further history of our podcast, you can go to marketswithmegan.fm. Thank you.